Hi, everyone. This is Sasha with the LPRC. Thank you for joining us for the 7 Vital Trust Accounting Reports to keep your law office compliant and successful with our sponsor, CosmoLex, as part of the LPRC Industry Insights Series held every Wednesday. Our speaker today is Erica Birstler, Vice President of CosmoLex, developers of the only fully integrated case management, billing, and complete accounting system specifically designed for law offices. Erica's degree is in business administration, and she has nearly a decade of experience in the legal software industry, catering to the specialized technology needs of small to mid-sized law firms. Erica is passionate about helping legal professionals improve the way their law firms run. She has given numerous presentations across North America on legal technologies, such as law practice technology management, cloud computing, and legal billing and trust accounting compliance to help spread her knowledge. Thank you all for joining us. We'll now begin the webinar.
Great. Thank you so much, Sasha, and thank you all for joining me on this webinar today. And to kind of summarize what we'll be covering is it's all about trust accounting, specifically a lot of related around compliance is where reporting comes into play. So we will take a little bit of time just to talk about trust accounting basics. The reason really being is all of these different entries that you do during your daily or weekly or monthly trust accounting activities, that is what makes up your reporting. So it is important to make sure that you get those things right and also understand what ends up on those reports and how they end up on those reports. Then we'll get into the actual reporting. So we have 7 specific reports that I've taken screenshots of today. We'll take a look at, kind of understand why they are required, what's different about them, how the data is presented, which I think will be very helpful just to see kind of samples of those. We will also be providing samples afterwards in a handout as well. The last part is how your technology can impact compliance. So the tools that you use can definitely help or hurt your efforts to remain compliant. And that also comes down to reporting. Reporting is basically a sense of data analysis. So in order to take that data and present it in the right way, you have to have the right tools to do so. Okay, so the first thing I want to talk about, I mentioned kind of the trust accounting basics. So from a very top level, that comes down to legal accounting. Legal accounting is basically all the different financial activities that your firm does day in and day out. But from my perspective, it breaks down into 3 distinct components. The first is business accounting. So this is what really every business needs to deal with. They track their firm expenses, or it should say business expenses, even your income, obviously, that comes in, reconciling of your bank accounts, and also tax reporting. So this is around the time of year where a lot of businesses are preparing for that tax review. The second piece, which is very unique to law firms, is matter accounting. So a lot of different businesses don't have to really focus on the financial aspect of each individual client or project that they're working on. But for law firms, of course, you need to focus on matter costs, even your trust ledgers. And that is one of the core principles of trust accounting, is to be able to have specific record and detailed audit trail for each particular matter. And payment allocations. When you get paid, how does that get applied to a particular invoice on a particular matter? And is there income on there? Is there cost on there? What are partial payments and how are those handled? Is a little bit different than any other business as well. And the last component kind of ties it all together, which is compliance. This, again, is part of the focus of today, is because trust account, which we'll talk a little bit more about what that is, but of course, a trust account is not yet your money. So it's held to a higher standard. And that comes down to trust audits, which is, again, where a lot of this reporting does tie into, but also legal specific requirements. So there may be certain requirements as to how you need to handle your accounting as a law firm in general, but also your specific practice area and how you handle those particular funds. It's important to keep those in mind with all the work that you do. Not every law firm is created equal either. So this whole big picture here is what I consider legal accounting, and it needs to be kept in the forefront of your mind, on a daily basis. So the component that, of course, we'll be focusing on today is the trust accounting. Now, trust accounting impacts both Actually, it impacts all three of these because it is the management of your trust accounts in accordance with compliance requirements. Now, why does it involve those three components I mentioned before? Well, it's a bank account at the end of the day. You're bookkeeping for a bank account, and you need to be able to reconcile and show that there's a track of activity that's taken place in that bank account, even activities like reconciling. That's a general accounting function. It would happen no matter what type of bank account you have. But the key component here is accordance with compliance requirements. Now, there are federal compliance requirements and also local. So your local bar association may have its own kind of degree of strictness of either enforcement or even their audit programs and how those are set up. I could tell you in New Jersey, which is where I'm located, it is a random audit program. So you can get called any day to be called for an audit. So that has to be taken into consideration when you think about trust accounting. What is required in your jurisdiction? And also the bookkeeping in general. Like I mentioned, bookkeeping happens no matter what type of bank account you have. So that could be your software records, your actual ledger, as well as your paper documents. So canceled checks, voided checks, deposit slips. That's another thing you want to make sure to know what is required in physical paper, what could be scanned documents, and what could be electronic documents as well. In terms of the types of funds, now some of you, depending on your practice area, you may be dealing mostly with escrow, you may be dealing mostly with settlements, which is in that top category, those large deposits that come in that you need to usually give out to third parties or to your client, highly transactional, and you'd be dealing with large sums of money for one particular matter. Unearned income is for those of you that handle a lot of retainer work. You know, if you're receiving those advances upfront for either fee or cost with the intention of eventually being earned, that's another common type of funds that can be in trust. And the last, which is probably the least common, but some of you may specialize in this area, is third-party funds. So if you are acting as that fiduciary, you're taking on that responsibility for, again, money that's not yours, it's for a third party. That's another way that you may be managing those funds. I do want to stress, which again, core principle of trust accounting, the reason why, or I should say the commonality between all of these is none of these are your money. And that's also why a lot of this compliance is so high and why things like these reports that we'll talk about is so important, because you're needing to prove your proper management of someone else's money. So here's the kind of the day-to-day workflow. And like I said, I wanted to briefly cover these functions because you may have different people in your office handling these activities. You may be doing them all yourself, but they all come together to factor into the reporting that is so crucial to your compliance. So the receiving of trust deposits, it could be those settlements, it could be those retainers, whatever money is coming on into that trust account, it has to be allocated to a specific matter. That's very important for your record keeping, and that needs to be presented on the actual deposit, you know, who this is specifically for. Withdrawing, that could be out to third parties, checks, wires, or even earning it for yourself. That too could be a check or a wire or some other form of payment, but you need to have a very clear explanation as to what happens to those funds, especially when they're going out. When they're going out to somebody else or even to the firm, there needs to be a record as to why that money is being taken out of that account. Printing checks I listed here because this actually kind of goes in line with reporting. Not only is it a convenience, obviously, you can print in high volume, but more from an accuracy perspective. If you manually write a check or handwrite a check, the likelihood of you referencing the wrong matter, transposing numbers, putting some sort of wrong information on that check is much higher than if you're putting it directly from your accounting system. So something to keep in mind if you're not already doing that. There's also a solid record of that check, when it was printed, maybe who printed it. You can get that information as well. Bank reconciliation, honestly, should be done for any type of bank account you have, not just trust accounts, but it's a requirement for the trust accounts with the intent of finding any discrepancies early on and correcting them as soon as possible. But this is a monthly task. So it's important to keep in mind that while you may maybe see receive money into trust or out of trust on a daily basis, that reconciling should be done at least monthly. I know firms that are highly transactional that reconcile weekly or daily because they just have so much money going in and out that it's too much to deal with at the end of the month. So they do it daily or weekly, and that not only helps with distributing the workflow throughout the month, but also allows you to catch those mistakes much sooner than later. If I made a mistake or the bank made a mistake on the 5th of the month, I can find it either today or the following business day rather than waiting till the following month. Then we get to the monthly required reporting. Most, if not all, I would say probably all the reports that we talk about can, but also should be generated monthly. It's a good way to stay on top of course, reconciliation reporting is always monthly, but everything else, I think it's good to have a nice stack or packet of reporting that whether it is you or a bookkeeper, that you are actually staying on top of those individual tasks. And that's something I actually wanted to bring up is in regards to who is doing the work. A lot of law firms either outsource their accounting or they have a specific accounting staff that handles these activities, or at least some of these activities, mostly the reconciling and the reporting. Perfectly fine. I'm a firm believer in only doing the work where your time is most valued and leave other things to the experts. But at the end of the day, the actual responsibility falls on the law firm. So things like reporting, like a monthly requirement of reporting, will help you be aware of what's taking place and is it being done in a timely manner and is it being done accurately? Because you want to, again, bring that accountability back to the firm itself and not think it's on this accountant that I'm using. It's on the firm actually when it comes to the trust account. So now that we talked about kind of managing the trust account records, I'm curious, all of you currently, how you're managing your trust reconciliation and reporting in-house. So the options are written ledgers, maybe you have a ledger book that you use, spreadsheets, general accounting software, something like a QuickBooks, a legal specific accounting software, or maybe you're not sure. So we'll leave that up for a little bit for everyone to answer. All right, so looking at the results here, we have close to half of you, about 43%, use a general accounting software like QuickBooks, followed by a legal specific software, and then written ledgers and spreadsheets. I'm happy to report that none of you are clueless, or at least those who responded to the survey. So that's a good thing, because like I said, you want to always at least be aware, whether it doesn't matter if you're doing the work, but have that awareness. Okay, great. So that actually we'll kind of circle back towards the end of the session about how those different tools can impact your trust records. So reports. These are the reports that we'll be talking about today. When you're handling your trust account records, of course, you should basically act or perform like you could be audited tomorrow. You never know. Some states, it just requires a client complaint, maybe a flag by a bank. Sometimes it's random. So you want to always be prepared that an audit can happen at any time. I know way too many firms. We've actually had a couple of firms reach out to us recently here at CosmoLex that say, my trust records are a mess, I'm getting audited, I need to put them in a software that gives me reporting, because they don't have that right now. So you don't want to be in that position to have to frantically pull that information together. Usually they give you about 2 weeks, but if your records are all over the place, that, believe it or not, that's not enough time. I do know some firms that end up almost closing their practice for a week or two just so they can get their records in order, and you don't want to be in that position. So one other thing to point out, of course, we'll talk about what these reports are. They may be named different things if you have different systems, not a problem. I do want to point out that if you have multiple trust accounts, which most of you may just have one, but if you have multiple, these reports have to be done for each bank account. That's very important. So if you have 4 bank accounts, you need to go ahead and run these reports for all 4 of them. Obviously, if you have a software or tool that can provide these to you, that makes it that much simpler. But I do want to point that out for those of you who may have multiple. All right, so I have generated a copy of each one of these reports from CosmoLex. For those who are unfamiliar, it is a cloud-based legal practice management tool, which of course also includes legal accounting. So we'll look at these screenshots, also talk about what these reports are, what's unique about these reports, and we'll be providing a copy as well. So no need to frantically take notes. When you look at these screenshots, you will be receiving your own copies at the very end. So let's start with our first report. This is the bank journal. So this is probably the easiest report. It's pretty straightforward. Just to explain what's here, it's your activity. I don't like to say bank activity, but it's your book activity. This is what you have entered into your book record for a particular bank account. And you can see here I have, and these are obviously simplified reports just so you can see all the data on one page, but this is your withdrawals, your deposits, even voids that might have taken place should be shown here as well. And you can see the first column is date. You have the transaction type, check number. Very important that obviously with a trust account, every transaction should be associated to a matter. I do want to point out though that if you do this type of reporting for your own business account, which is also a great thing to do, that even items that are linked to a file, that are related to a file, you want to make sure that that matter reference is there. So see, here I have who's the payor, who's the client, if there's a memo, is it an increase or decrease, and then the balance. Now what's important here is there's a running balance. You'll notice on a lot of these trust reports, running balance is a column that is required. Why? Well, that will point out an overdraft. So that's one of, again, the core principles of trust accounting is not only, this is the bank account level, not only should you not overdraft on the bank account, but when we get to the individual ledgers for your matters, you shouldn't overdraft there either. And these reports will highlight those types of situations. Now, Bank Journal breaks down into two additional reports, one of which is the Trust Receipts Journal. This is the deposits half of your bank journal. So oftentimes it is easiest to look at accounting reports from deposit perspective on one side, withdrawal perspective on the other. Sometimes a auditor or whoever needs to look at your records might be inquiring about specific deposits or a group of deposits, and this just makes it a lot easier for them to comb through those records, and they may actually require that you have this split out in this way. Some of the points that are on this report. So obviously at the top you have the bank account. So like I said, this is per bank account. You have the date, the transaction type, and again, the payor and the matter. Very important to have that matter reference. I do want to point out on the right, we have the amount, and we also have a deposit slip total. I don't think any of these that I have here is on a deposit slip, but I wanted to bring that up from an accounting perspective. So when you are, if you go to the bank on, let's say, tomorrow, and you bring 5 checks with you, you may have a deposit of $10,000, but that $10,000 is related to 4 different matters. So your bank record is going to say we have $10,000 in the bank, but your book record is going to have multiple transactions that you're going to have to cross-reference. So some accounting tools do actually provide a deposit slip type of function where you can group those deposits, which is great. It's very helpful for reconciling, but you want to make sure that your reports also reflect that. So if whoever's looking at your reporting is comparing this to the bank record, they could see exactly what, why those are grouped together. So I do want to point that out. The flip side is the Trust Disbursement Journal. This is the money going out. So believe it or not, this is probably one of the most important reports because the issue is, well, I mean, you can have issues with depositing funds if they're not recorded under the right matter. But when you're taking money out, you need to make sure you have things like in the memo, you need to reference the reasoning for that, the who it's to, what the client is and the matter is, and of course the amount. So this is how they can go down the list and verify particular checks. If you said there were 50 checks that month, they can go here and check that out. Now, all of these reports, I happen to run these reports for a specific month. They may ask for months, years, several years. So keep that in mind as well, that if you started your records at a certain point in a new tool and they ask for, let's say, 7 years, that's the most drastic, I think, situation. But how would you be able to produce that for that full record and not just the current month? Trust ledger balances. So this is basically how you can see the balance in each particular matter that you have. It's great to just keep an eye on this report so you could see what each person has. Ideally, any accounting system, or I should say legal accounting system, in the screen itself without even having to produce a report, you should be able to see each matter and what they have available in the trust account, but here it is in report form. A few things that's important about this, obviously, the total that I have here at the bottom, right here, should check with the what's available overall in that bank activity report for that month as well. So to be able to see what my book record and all of my matter should add up to the same number, that circles back to a three-way reconciliation, which I'll talk about in just a moment. But they do a lot of cross-referencing between these reports just to make sure that if this did not match what's in your total book record, that means that there's some funds that's not associated to a matter, and they would need to figure out why that is. Again, some tools actually don't allow you to have unassociated funds, so that's a way of preventing that issue. Last activity here is also important because you may have a matter that hasn't had activity for 2-3 years. Well, why is that? It could be a long-term case, which is fine. But what if you left money in there and forgot about it? What if there's, $500 in there that's supposed to go back to the client? Or maybe it should have been earned by the firm and you never earned it. Sometimes those things get forgotten. I could say, especially with the earning of funds, I want to give you a point there. Every firm's kind of different as to when they shift those funds over to their business account. Do it as soon as possible, because the longer you wait to physically move those funds to the trust account to your business account, the more inaccurate your bank balance is. You'll look at it, you'll possibly think there's money there that's not actually there, and you could forget about it. Funny enough, you'd think you'd never forget earning money, but if it's not done sooner rather than later, it can be forgotten. So this last activity can help you to see if there's any old files that need to be worked on and maybe just money returned to the client. The next report is the client trust ledger. So this is like you go from the balance report. So let's say this is Jim Collins. I saw Jim Collins's balance and now I'm drilling into that. I'm going deeper into his specific file and what actually took place. This I like to call like a mini bank statement for a particular matter. No other business needs to worry about this type of thing, but it is a requirement for the trust account. I need to be able to provide to my client everything that took place, money in, money out, current balance in that particular account. And if you have multiple bank accounts, or trust accounts, I should say, especially if you happen to have, which is a little more rare, but if you happen to have a client that has money in more than one trust account, you need to be able to produce one of these for each account for that particular client. So they all should have their separate ledger. And here it's also pointing out that there is a running balance. Yet again, it's keeping an eye on if that amount has gone negative. If it's gone negative, they're of course going to ask you what happened in that situation. A few of the things when we talk about with technology can prevent that. In general, the ideal situation is to prevent. You would rather not have it happen at all than for have it to happen and have to explain why it happened. So that would point out to anybody reviewing these reports if there's been an overdraft. A point I also want to mention is I keep saying the auditor looks for this, the auditor looks for that. Even if you're not audited, these are things that you can look for each and every month to see, was there an overdraft? If there was, well, hold on. Why did this happen? And kind of get to the bottom of it and try to rectify it or figure out the situation before it even gets to that point of an auditor. Trust transfer record. So what's interesting about the trust account is you have very often one pool of money that's associated to multiple people. There's also the concept of matters. So, John Smith, I might have 5 matters for John Smith. You should still have matter-based ledgers. So I should have 5 ledgers for John Smith showing what has been done with that money, because those are 5 different activities I'm doing for him. One could be his divorce. The other one could be he's selling his house. Those are 2 completely separate situations. And even though it's the same person, they should be kept separately. However, in some situations, you need to move funds from matter A to matter B, but it's in the same bank account. You're not actually sending it off to another account, but you need to move money around. That is called like a trust transfer. Some, I would say mostly legal specific tools have might have the ability to move those funds. It's basically just a shifting without actually creating a transaction, but you need proof of when that shift happened and why it happened. Shouldn't just be moving money around for the sake of moving it. So in CosmoLex, for example, we do have a trust transfer tool, and it keeps a record of why those transfers happened and the reason. So if you ever do move money around like that often, you want to have some way of producing why that money is being shifted. And then our last two reports have to do with reconciling. So I mentioned how important it is to, not important, required for you to reconcile your trust account each and every month. For those who don't do reconciling yourself, it's basically checking your book record against your bank record and seeing if there's any discrepancies. And if there are, addressing those. It could be a staff member put in the wrong number or the wrong matter or the wrong date. It could be the bank put in a double deposit or double withdrawals. Things happen all the time. So you need to first reconcile, and then a reconciliation report is your proof of that reconciliation. So you can see here I have at the very top my date, I have my amounts, my beginning balance. This happens to be a beginning of a bank account, so I started with a $0 balance. What is cleared, what is not cleared, which you see down here, uncleared deposits and payments, and what was remaining in my bank at the end of that month. Now, the more important part, so the summary is great. The more important part to me is these uncleared items. I think very often they are overlooked. With the trust account, any money that, especially that goes out of the trust, until it is cleared, it is your responsibility. So you can have situations where you send a check to a vendor, months go by and they never cash it, or a check gets lost in the mail, or a client could be holding on to something and again not cashing it. It is your responsibility until that is cashed, and you want to follow up on those items. It is perfectly normal to have uncleared items on a reconciliation, but they should not be there long term. So if you see the same uncleared items here, month over month over month, there's something going on. Somebody needs to follow up with that vendor or that person, say, hey, did you get this check? If so, could you please deposit it? Because my books are basically out of order right now because of it. And that's what gets looked at as well. If there's long-term pending items, they need to be addressed. Another point is if you have something that is several months old, that let's say you tried to return money to a client and they never cashed it, you couldn't get in touch with them, then there's a process for unclaimed funds that you need to follow for the trust account. If for some reason you cannot find a way to get this money to that person effectively, then you need to follow your process for your local bar for handling unclaimed funds. And then the last report is the three-way reconciliation report. This is specific to the trust account. It is taking your reconciliation report to the next level because it looks at your book balance, which I have here, my bank balance, but also, which is on the next slide, all the individual ledgers. Those three numbers need to match. Again, that is showing that every dollar that you have in your trust account is associated to a particular file. If there's a difference, that means there's money floating around that you don't know who it's for. So this three-way check often is required in an audit, and it just shows that you're handling your trust account appropriately. This is definitely a legal specific report. Tools like QuickBooks or generic accounting tools don't have this type of reporting. So you do want to make sure that you do have a way to provide that. Okay, we'll wrap up now. Some general practices. This is just some pointers. Actually, I covered a lot of these already. You do want to generate these reports monthly to make sure that your accounting activities stay on track no matter who's doing the work. Know your current audit requirements for your jurisdiction. Know that retention may be required up to 7 years. Check with your local bar and keep the records at least up to what they say is the requirement. And then you could slowly, likely you'll keep them anyway, but just keep in mind that you may need to produce reports for that time period. And understand what's required in terms of physical copies of certain documents. And the last part is in regards to the tools. There are several tools, as you see here, which we had in our survey earlier: written ledgers, spreadsheets, generic accounting software, legal specific. And on the left, I put kind of the basic functionality that you need to manage your trust account appropriately. So having an electronic record is helpful for, being able to access your records outside of the office, as well as to be able to collaborate appropriately and to have proper backups of your transactions. Built-in reconciliation, that's a basic accounting function. You need to have that to stay on top of that requirement. Ability to close your books, which prevents people from making mistakes after it's already been signed off. You don't want, if you have a staff of 10 people, you don't want one, paralegal going in and start changing things when they're not supposed to. So you want the ability to close your books, required matter-centric records, not just the ability to do it, but have a requirement. You don't want to end up with funds that are not associated to anyone. And then certain safeguards like preventing overdrafts, appropriate reporting, no duplicate checks. Those will all just make sure that you're functioning the way that you should. And take a look at the tool that you used currently as to how they meet those requirements. And you could see, obviously, anything that is legal specific is tailored specifically to trust accounting and ensuring that you're handling your records the best way possible. If you're using any of these other tools, definitely keep in mind, how are these requirements now being met, if at all? And if you're not doing the work, speak with the person who is, and you can ask those questions to make sure that they're living up to these basic trust accounting standards. Okay, that wraps up our session today. Of course, if anybody wants to learn a little bit more about CosmoLex, you're more than welcome to reach out or visit CosmoLex.com.
Okay, awesome. Thank you so much for speaking, Erica, and thank you everyone for joining us. One more time, thank you to CosmoLex for attending for presenting for our Industry Insight webinar. If anyone is curious about any future webinars, please check out the ABA LTRC page or follow our Twitter at LTRC for updates. One more time, thank you, Erica, for presenting today. We will now conclude the webinar.
Thank you so much. Thanks, everyone.
Bye, everyone.